What are the charts saying about whether there's a bottom in sight for this market?
Oh, yeah. So for the equity market, we've cited over the last couple of weeks how oversold the market had gotten during the time of year that you'd expect weakness, which is usually September through the first week of October. So our thinking is, you saw an initial bounce ahead of payrolls report. The market was disappointed by the payrolls report and the subsequent move in the fixed income markets, which showed a bit more of an aggressive move by the Fed in terms of expectations of terminal funds rate and those sort of things. So stocks now are pulling back to those levels. The good news is after a 2-day bounce, you don't alleviate those oversold conditions. So our thinking is still that in the 3,500s, there's a large cluster of support, and the market should put in a bottom ahead of a fourth quarter rally thereafter.
All right, so if that's the case, you're looking at the S&P 500 and what the charts are kind of indicating there. We mentioned before that the Dow is kind of now back to where it was pre-pandemic in February of 2020. The S&P would have to go lower from here by about roughly 100 points to get to that same kind of level. Are we talking about a market now that's kind of grappling with this idea that we're not maybe that much better or worse off than we were back in February of 2020?
Well, from our point of view, when you look at the supports on 3,500s, you hit the nail right on the head. That's where the market gapped out in November of 2020 when the headlines from the Pfizer trial were released and showed an effective vaccine. That's the period of time where you saw what initially was growth type and let's say quality earnings stories, where you saw that transfer to more value and cyclicals, and the market got really excited about the prospects of the economy. So from our point of view, that's an important psychological level, along with all the other levels that sit in that area on the chart. Not to mention, we're also watching a very tight relationship that's existed over the past year. Once inflation really started to tick up in the fourth quarter of 2021, you saw this tight relationship start to form between the expected terminal rate for Fed funds and the S&P. If you look at that particular model and the tracking error of the S&P around it, 3,500 more or less is where you'd expect the market to go with what right now is priced to 450 terminal rate. So a lot of things are pricing to the same area, including what you had mentioned, kind of giving up all of the COVID recovery excitement and the oversold conditions. Things seem to be lining up from our point of view that suggest at the very least you'll see some sort of a position squeeze and rebound in the fourth quarter.
It's hard to debate, Jason, that interest rates are driving a lot of the downside volatility. You can see it every time there's any kind of an economic data point that implies more Fed tightening or more aggressive tightening. You see the markets sell off the way that they do. It's the proximate cause of all the downside that we're seeing right now. So take us through what you're seeing then in terms of where we could expect to see interest rates move. You mentioned the terminal rate for Fed funds. I'm looking at now maybe what the 2 years going to be, what the 10 years going to be. How inverted does this get?
So we'll start at the short end, and we've heard a number of what are perceived as hawkish Fed speakers over the last week or so, particularly around the payrolls report and leading up to it. At least two of them that I could remember had mentioned 450 as kind of a landing spot on the tightening. And if you look at the forwards, which the 2-year note roughly implies, is up to that 450 level. So if we're looking at the front end, we're getting to, let's call it peak hawkishness in a sense. Assuming the Fed speakers do what they've said. As we move further out on the curve, the 10-year note has cheapened up to roughly the 4% area. On the chart, there's a couple of technical levels in that area. Despite the fact that it's also a psychological, nice big round number, 4%. And similarly to what we're seeing in the equity market, the deep oversold conditions, you're getting the same type of setup in fixed income, not just in the U.S., but if we look at other developed markets as well. So our thinking here is the market's backing up to retest the high yield that was put in a couple of weeks ago in a fairly chaotic way. It seemed like a blow-off type yield top. Our thinking is that you're not going to sustain much of a move through 4% for the 10-year note, and you'll set up for a rebound as we move into the fourth quarter, which is kind of unique for anyone in our generation or even the generation before that. Normally, you expect the inverse relationship between equities, but we generally think if it's not the U.S. dollar, it's setting up for a rebound in the fourth quarter. And our thinking is as the market rallies, 3% is probably as rich as the 10-year note will get for the next quarter or so.